Welcome everyone to this week's presentation of the market call.
Price evolution.
We're going to check, as usual, first the evolution of the prices. As you can see, prices have been increasing over the last week following the bullish trend that has started as a result of the geopolitical escalation between the US and Iran. This practically has affected over the past week throughout all commodities.
Latest news.
If we take a look at the most important energy news, we will see first that recently we have seen a sudden diplomatic pause that has halted the attacks between the US and Iran after they have reached the truce. Nonetheless, the traffic to the strait still remains relatively limited, and as such, the current market reactions that we are seeing, which has been downwards, has been as a result of this news flash. In other news, we have as well the resumption of the tariff situation in which the US, the Trump administration, has announced a series of new import tariffs, among them a 50% tariff on Canadian goods, 100% on foreign-made generic drugs, a broader 10 to 12.5% tariff on imports from 60 partners, among them the EU, and the main reason for that is the failure to target forced labor, according to the US. We have seen the Nasdaq already reacting to this news, as you can see on screen, with a downwards movement.
Weather.
Moving on with the weather, what you will see now is that across Europe we can expect temperatures to increase, and as such, a potential heat wave during the middle of this week can be manifested, and that could push higher for a cooling demand. In addition to that, we can expect some low wind speeds, and couple that with the hot weather that could be put a strain on the power system.
Macroeconomics.
On the macroeconomic side of things, we have the data for the PMIs. Here we can see on screen the composite PMIs for the different areas in which have increased by a little bit, with the exception of India, which have seen a retraction but still remain above 50. For the inflation rate, as you can see on screen, Japan and the UK data has been published for June 2026, in which they remain relatively stable.
Crude oil and LPG.
If we take a look at the price evolution, we will see that prices last week have ended at quite high. September 26 for Brent, for instance, have ended last week at 96.78. We will see as well, according to the US stocks of crude oil, that there has been a small rebound, as you can see on screen, and that is due to the refilling of mainly crude oil as well as petroleum derivatives. When it comes to the fundamentals that have driven the oil prices recently, first of all, we have to mention the fact that the current situation on the Strait of Hormuz, which is a key oil choke point, has been the main reason for the bullishness that we have been seeing over the last week and the volatility that we have been seeing since March this year. But nonetheless, the sudden pause in the US-Iran hostilities have pushed for a strong market correction, with Brent prices trading at just below $90 per barrel. We also have the new US trade tariffs that are sparking fears of global economic slowdown and demand destruction. But nonetheless, the risk of potential higher volatility can be expected as the traffic to the Strait of Hormuz is still not reopened fully, as well as other fundamentals, as you can see on screen.
Natural gas.
When it comes to natural gas, we will see here that last week we have ended quite strong, with a strong bullish ending, with prices in many cases reaching or surpassing the ones that we saw in the peak of March 2026. Apart from the geopolitical fundamentals, what we can expect as well is that the gas storage levels refilling rate has been relatively poor compared to last year. We will see that the gap between last year and this year has been widening as a result of a similar injection rate throughout 2026. If we take a look here, we will see that the injection rates for 2026 has been consistently stable, but still below those of last year, and that of course has added to the gap between that is ever growing between the gas storage levels of last year and this year. When it comes to the fundamentals, we have to mention that as well, that the Strait of Hormuz situation has been the main driver when it comes to the gas price movement, but nonetheless, we have other fundamentals to take into account that could have pushed even further upwards the prices for natural gas. Among them, we highlight the heightened competition with Asia. We also have Egypt emerging as a new structural buyer of LNG, and the European gas storage levels that remain at a significant deficit, and all of these are helping in keeping the bullish trend. Nonetheless, we have recently seen a correction in energy prices, among them as well, including natural gas prices, as a result of the escalations between the US and Iran.
Coal.
As you will see on screen, coal prices have remained relatively stable with a lack of higher volatility levels to what we have been seeing on the oil and gas market. Coal prices have been governed by the following fundamentals, as you can see on screen. First of all, we have the record low water levels on the Rin River that is threatening to hold the barge traffic, and as such putting constraints when it comes to coal deliveries from the Arab ports in the Netherlands to German power plants. We also have in China the weak wind output and other constraints that have increased the coal demand.
EU and UK emission allowances.
For the carbon emissions market, as you can see on screen, the bullish trend has also been noticeable and consistent over the past few months. We have seen how last week the evolution has been consistently bullish, although to a lower extent to that of the previous commodities. For the fundamentals that have driven the carbon price movements, first of all, we have the proposed EU ETS reform last week, which have failed to cause a bearish reaction. We also have the forecast of a heat wave and low wind that could increase the demand for fossil fuel generation and thus potentially causing higher market movement for the short-term products for the carbon allowances. On the bearish side of things, we have the escalation in the Middle East that have prompted a correction across all energy assets, and as well the risk of a pullback on profit taking by speculators after these prices for carbon have hit a 6-month high.
Electricity.
If we take a look here, we will see that the German power evolution has been also quite bullish, with prices already surpassing those levels of March 26, a couple of weeks before gas did. You will see that this bullishness has been noticeable for all European electricity markets, as you can see on screen. When it comes to the fundamentals, first of all, we will have to review the total grid demand that has remained relatively stable. If we take a look and zoom in on the renewable production, we will see how solar generation has been consistently strong. Nonetheless, hydro run-of-the-river generation has been performing quite badly, and as such, that has prompted for, or could be considered as one of the reasons behind the consistent bullish trend that we have been seeing on the power markets in Europe. We also have to take into account the fossil generation, which for now has remained below the average. Nonetheless, important to note that to the coming heat wave, it will be interesting to see how this graph will evolve. Overall, fundamentals governing the power markets, apart from what we have discussed regarding the Strait of Hormuz situation, which has been moving the gas markets upwards and oil markets, power prices have also been sensible to those movements. But on top of that, we have seen the carbon prices increase that has lifted as well power prices, and the risk of a heat wave across central Western Europe, which could potentially increase the cooling demand, which could as well affect the short-term prices. French nuclear output also remains constrained and could be curtailed as a result of higher river temperatures and the drought conditions that is making hydro generation perform poorly. Nonetheless, the strong solar generation at times could push spot prices to near zero levels, allowing for more supply of electricity in the European grid. The de-escalation in the Middle East as well has caused a sharp drop in fuel costs, and as such as well on the European power futures. Finally, we have the geo prices, which have remained relatively stable with a small retraction, nonetheless, due to the poor and concerning Nordic hydro situation. We see that the prices have yet not corrected to the levels that we saw a couple of months ago. Thank you everyone for listening to this market presentation.